Hey, everybody. This is Brooke Bryant on Realty Success Hub. I'm a realtor in the Charlotte, North Carolina area and surrounding areas, and I co host this great show every week. And I'm also an author. I love working with first time home buyers, so I wrote a book about it, The Ultimate Guide for First Time Home Buyers. Everything you need to begin the process to buy a home all the way through closing. And I'm so excited to be with everybody today. And joining me is Angela Brown. She's the one who gets our homes ready to hit the market. Angela, how are you?
I am super excited that I'm joining you here today. I am the author of The Ultimate Guide to Move In, Move Out Cleaning. My name is Angela Brown. I'm the CEO of a company called Savvy Cleaner. We train house cleaners and maids all over the world. We're in 191 languages and 37 countries. What we've learned is this: no home is sold until somebody comes in and does the cleaning. So I'm honored to be part of this show today. Thank you so much. And Aaron, tell us how you're doing today.
I am fantastic. Thank you. I'm a realtor out of San Antonio, Texas, going on almost 14 years in the industry. So, pretty excited to still be here and part of it, and author of the book Pride and Property. So, I'm super happy to be here today. We've got a phenomenal guest. We've got Alex, all the way out of Charlotte. And we're super excited to have him here today. He's with AP Mortgage. And Alex, maybe you could tell us just a little bit about you.
Yeah, Aaron, thank you. Thanks everybody for having me. My name's Alex. I am a loan officer with AP Mortgage in Charlotte, North Carolina. I'm running the branch there. I've been in the mortgage industry for 4 years now, so seen the good up and down of the industry, and I'm excited to be here to talk about VA loans, other options for home buyers.
The OG of mortgage right there.
Yeah, so we're so excited to have you with us, Alex Mignone. Did I say that right?
That's right. Yep.
So, what drew you to the mortgage industry? How did you get started in that?
Yeah, I think just like any other loan officer, you kind of fall into it. It wasn't something that I thought about growing up to be in the mortgage industry, be a loan officer. So I just happened to run into somebody that owned a brokerage a couple years ago prior to COVID, and while I was in college, and I was like, "Hey, you want an intern?" And he was like, "Sure." And started going in there. I was basically a loan officer assistant, and I really enjoyed. I enjoyed it right off the bat. The industry as a whole, the whole everything around mortgages really and how it works. So that's what drove me to become a loan officer, and I became licensed tail end of college and stayed in it out of college. So and still in it. So you kind of fall into the industry, but then it's very difficult to leave. So most of the time people don't want to leave the industry, but yeah.
Well, I understand that you're a specialist in VA loans. And if you would, tell us, what is a VA loan and how is it different from other types of loans?
Yeah, a VA loan, it's one of the four conforming loan products in the U.S., which the four would be conventional, FHA, VA, and USDA. VA, USDA, and FHA are backed by the U.S. government. And VA being for veterans. Specifically, you have to be a veteran or a spouse of a veteran to get a VA loan. And there are many benefits involved with doing that. I mean, it's specialized towards our veterans, right? So they deserve that. With 0% down to be able to get into a home, a lenient guideline, so on and so forth that we may get into, but maybe even lower interest rates as well. So it gives a product to our veterans that might be really a lot better than some other loan options out there.
Wow. I get the question a lot from our service members of how do they qualify in terms of who's eligible? Do they have to be active duty? Do they have to have served a certain amount of time, et cetera?
Mm-hmm. Yeah, that's a great question. Yeah. Well, they can be active duty. They don't have to be active duty as well. It really depends on if you were in the armed forces or if you were in the reserves or the Coast Guard, whatever it may be. I know there's some times where you have to be in there for 6 years and be in service for 6 years. Sometimes it's a lot less. So it does depend on which branch you are in. It's and then you're granted an eligibility certificate of eligibility that your loan officer that you're working with can look up very easily during the pre-approval process. So when you're ready to go look at homes or get into the process of buying, they can easily access that certificate of eligibility and make sure you're eligible.
So you said that there are some benefits. So if I'm a veteran or the spouse of a veteran, why would I choose a VA loan over an FHA or conventional? Like, what are some of those benefits as far as interest rates, or said 0 down?
Yeah, the number one benefit, 0% down. Being able to do 100% financing. It's really the only loan that you're able to do that out there or in the mortgage space right now. Another great part of a VA loan is there's no mortgage insurance, right? So with a conventional loan, if you don't put down 20%, you're going to have mortgage insurance. FHA requires mortgage insurance for at least 11 years. Most of the time, the life of the loan. VA, you're able to put down nothing, have 0% down, and no mortgage insurance. So it gives you a lower monthly payment. Interest rates are typically a little bit lower as well. We'll compare it to conventional because that's your standard loan in the U.S., very popular loan. Mortgage or VA rates are going to be a quarter or half a point lower than conventional as well. So those are a couple options right there that give veterans a lower monthly payment to begin with. Yeah. So I would say those are the three best.
On that note, Alex, what about taxes when it comes to the VA loan?
With property taxes, you mean? So escrow is still standard, mostly with a VA loan, as it would be with other loans. Some veterans may be exempt from property taxes, maybe the Homestead Act. I know in Florida, I've seen it depends. From my experience with VA loans, I've seen just normal property taxes wrapped into the escrow account, which is wrapped into the mortgage payment.
Fantastic. Okay.
Yeah.
So that's so fantastic that there's no PMI included in that. And a lot of folks out there aren't really sure what PMI is. Can you give us like a little more in-depth look at that? Tell us what PMI is and why this is such a great benefit that if you are a veteran or qualify for a VA loan, why that's so important.
Yes.
If you'll go one step before that and explain what PMI stands for.
Right.
Private mortgage insurance. And then MI is mortgage insurance. So you're going to typically hear PMI with a conventional loan because it's privately held. Mortgage insurance, or MI, with an FHA loan because it's government backed. And essentially what this small payment it's wrapped into every monthly payment that a buyer will make, or borrower as we call them in the mortgage industry, it protects the lender against foreclosures or default. We don't want to have another 08. And this insurance that the lender has, they're able to have a pool of this money that can help them buy out a foreclosure or delinquency if that need be. So it protects the lender. Conventional, you're going to have it unless you put down 20% or more, which at 20%, the lender, you have a sizable investment into your home, which protects the lender. FHA typically allows borrowers with maybe lower credit score, higher debt to income ratio qualify. So they also want to protect themselves as well because the risk of foreclosure or default may be a little bit higher, right? So that protects with FHA. VA just doesn't have this. And it's a benefit to veterans to lower their payment. So it's a wonderful thing with VA, really. I mean, you can save hundreds of dollars a month from not having mortgage insurance. I mean, I've seen mortgage insurance on conventional loans very high. FHA loans has a set amount too. So it's a great thing.
So how does the VA guarantee the loans?
That is a great question. I'm not completely sure, to be honest with you, on how they actually guarantee the loans. There is a secondary market for mortgages too, so I, yeah, I would have to look into that a little bit.
Yeah, I don't know either. So we're twins.
Now, I hear when it comes to VA loans, I know there's funding fees. It used to be that, the buyer used to have to pay, or the seller used to have to pay some amount for the buyers, et cetera. Could you talk to that just a little bit about what that is today and what that looks like on a loan?
Yep. So typically there is a funding fee on a VA loan, which is a percentage of the loan, and that can typically be wrapped into the back end of the loan if the loan to value permits it. A lot of times this is waived though, because if you are deemed 10% or more disabled by the military, which this shows up on the certificate of eligibility, so your loan officer can be able to tell you whether this fee is waived. If you're 10% or more disabled, it is waived, which I did a VA loan for a gentleman, and he was deemed 10% or more disabled because he had tinnitus just from being on shooting range and not wearing ear protection. So you don't necessarily have to be disabled from going into combat. It could be a variety of things, right? So I've seen funding fees waived way more times than not. So it's
Is that absorbed by the mortgage company then?
yes. So that actually is going to be paid to the VA as well. So like I said, I have to look into this, but that might be one way that they're protecting themselves as well with VA loans. If you look at FHA loans, there is not only mortgage insurance on your monthly payment, they also have upfront mortgage insurance as well, and that is a percentage of the loan that is paid to FHA as well at closing. It's a one-time payment. Yeah.
Okay. Yeah, and I know that it used to be that sellers had to pay a percentage. Did they do away with that across the whole United States? I know they did here in Texas a couple of years ago.
Texas has some interesting mortgage laws, so when I have to look at
Right.
it does, especially with cash out refis. I'd have to see if that's an actual requirement in Texas. I don't know if that. I don't think that is a requirement of the seller. I've done a couple VA purchase loans this year. There was not a requirement for the seller to pay anything. They did get seller concessions, but that was.
Is it still required in other states? I wonder. Like, is it required in Charlotte?
North Carolina, no. I would have to check to see if other states do require it. And states are funny too in the mortgage industry, and you hear a lot. Loan officers, sometimes people will say it doesn't matter where your loan officer is located. I don't necessarily believe that, because states do have specific laws around mortgages that change things up. So it is good to know, if I was working with a client out in a different state, even though I may be licensed in, I might not be familiar with those local laws. So it might help in that scenario to work with a local loan officer.
Yeah, I totally agree with that. I think having professionals work with you that are really familiar with the local market really makes a big difference in real estate. From some states require closings through attorneys, some don't. The lender who's familiar with the state guidelines and a realtor who's familiar with the state guidelines, I think, is super important.
Right.
And then where I'm located in the Charlotte, North Carolina area, we're close to the beach and the mountains. So that brings to my mind, what kind of properties are eligible for a VA loan? So if I'm a veteran, can I buy a second home, a vacation home through VA, or can I buy rental properties, investment properties with a VA loan?
I've typically only seen purchased upfront primary. I have seen it where people have moved out of their primary. You can get a second VA loan, but they went to go purchase another primary. The loan on the property they moved away from that they kept was VA. So it is possible to have multiple VA loans. I've only seen it on primary though.
So if I sell my primary residence and then buy my next primary residence, then I can do another VA loan. So it's not just one home purchase in your lifetime.
Correct. Yes.
And Alex, how long do you have to stay in the home before you can purchase it, lease it, etc., on a VA loan? Or does that vary per state?
I'm not completely sure of the actual time. I know generally you're going to sign a document, a disclosure at closing that states you need to be in the home for at least a year when it's a primary residence. Because buying an investment home, regardless of the loan type, the lender is going to have higher rates for investments because it's a higher risk, right? So we don't want people that it's actually one of the highest rates of fraud in the housing industry is people going to say they're purchasing a primary residence, but it turns out to be an investment home. So we don't want that happening. No, I wouldn't be
going to say we get that all the time here with VA loans and people wanting to purchase for family members, etc. So
yeah. So that's definitely not something you want to be involved in. Lenders are very savvy in figuring that out too. So they're going to go off of how far away are you purchasing a home from where you currently live, stuff like that. If you try to purchase a secondary residence, right down the road from you, they're going to flag that. Yeah, they're not going to be like, yeah, you don't need a second home like on the same road that you currently live on. So this stuff.
Vacation home.
Yeah, that's our vacation home's down the road. Yeah, so.
What is the appraisal process for a VA compared to a regular traditional home? Is there a different scenario?
Not really. I mean, from the client-facing perspective, no. You order an appraisal. Now, the one benefit when it comes to appraisals with VA is that if the value comes in under the purchase price, there's this tidewater effect, they call it, initiated, where the realtors representing the buyers can submit, they have 72 hours to submit their comps to the appraiser to have it relooked to bring the value back up to the home. And we actually had, or bring the value back up to the purchase price. We had one earlier this year, a VA loan. The appraisal came in lower, and the buyer's agent submitted comps to the appraiser, and the appraiser came back within that 72-hour period and raised the price up above the purchase price. So that's a great.
Is that for resale value?
Yes,
that would matter.
Yes, absolutely. Yeah, and in this market, I have seen a couple appraisals come in low. They're not terribly low though. Maybe $3,000 to $5,000. So it's negotiable, especially when people don't want to relist their home too. So buyers are a little protected right now with that. But with VA, you do have the opportunity where if the appraiser comes in low and say, hey, wait, no, we have comps that support that your value's on the low side. Submit those, get the value back up. But in terms of the process as a whole and ordering an appraisal, no, it's fairly the same.
Can you talk to us a little bit about the limitations on a VA loan, maybe a traditional versus jumbo, and kind of what that looks like?
Mm-hmm. Yeah, so limitations, I would say VA is more lenient on guidelines than other loan programs. So, for example, the max loan amount in the lower 48 states is $726,200. The same as conventional. Above that would be jumbo, just like a conventional. Debt to income ratio, which is a major thing right now of people being approved or declined, and which is always the case, but major right now. We're seeing people with a lot more debt, a lot more credit card debt. Their DTI is going up, right? So VA actually allows a higher debt to income ratio than conventional and FHA. So your odds of getting approved with a VA loan than the conventional FHA is higher. I mean, I was able to generate an approval with a gentleman. He had a 64% debt to income ratio, which
Whoa.
is very high. And there's a difference between what you can qualify for and what you're comfortable with. So that's a conversation that needs to be had as well. But it does put people in a, it gives them more options. FHA's maxed out at 57, conventional's maxed out at 50. So I feel like it's a little more lenient. And you can go down to a 580 FICO with a VA, conventional 620. So not only you're having these options of 0% down, no MI, interest rate typically is a little bit lower. The actual guidelines from the loan officer perspective of being able to qualify people a little more lenient.
So quick question on that. Between a regular VA loan and a jumbo VA loan, what are the different qualifications that someone has to have, or are they the same? Like would they have to have
I mean, jumbo, we would need to see more income. It's going to be a much higher payment, right, from the start.
So lower DTI and more income.
Yeah. Now and just to go on that as well, there are situations where someone's debt to income ratio may be capped at 45%, depending on FICO and other things that might be related to the profile, because there's many different things on the application that could affect qualification, right? So that is one thing to note. Working with your loan officer, they have to dig into it really. It's not as cut and dry, I guess you could say, but yeah, jumbo roughly the same. Yeah.
Okay.
So you mentioned the debt to income and people are carrying more credit card debt, that sort of thing, which maybe, do you see a lot of situations where people have multiple revenue streams and some of them aren't necessarily reported? So they've got cash. I would think that might be a situation that would be, the veterans might have that situation where there's some multiple revenue streams once they get out of the military. There's just so many different ways with driving Uber and that sort of stuff. Are you seeing that? And so how do you build that in?
Across the board, yes, we do. I do run into people with a lot of different revenue streams sometimes. A lot of times it may not qualify because it maybe there might be some type of self-employment and they're writing off a bunch of on taxes, which lowers their income on paper. With VA in particular, a lot of people receive disability from the VA, qualifies just fine, and then they might have a job outside of the service. So, and those qualify fine. I've seen Social Security as well. With Social Security income, we can gross that income up because it's technically not taxed. Some people do pay taxes, but in general, if they're just receiving Social Security, we can gross that up a little bit, take higher than what you're actually receiving, to kind of pretend like if you were to pay taxes on it, what would your gross income be? So yes, but multiple streams of income, yes, a lot of people do have those. Yes.
Can VA loans be used for refinancing, and how would that work?
That's a great question. And this is also one of the best things about a VA loan is it's called a VA IRRL, IRRL. And it's a standard refinance for a VA loan. And it does not require showing income or appraisal. So it's a very streamlined process. Yes. So, and this is similar to FHA. FHA has the same setup. It's called FHA Streamline. Does not require income or appraisal. The benefit with VA over FHA, though, is that you can roll the closing costs of the refinance into the loan. With an FHA Streamline, you cannot do that.
What?
Yes. It's so it would be zero out of pocket, which usually with closing costs on a refinance, it's typically your escrows. So you have to refund your escrow account, your property taxes, your insurance, whatever it may be. And that requires some upfront cash. If you're, have your loan with Mr. Cooper and you're refinancing with, let's say, my company, even though we're having to refund your escrow account, Mr. Cooper is going to cut you a check once that loan gets paid off for your remaining balance in your escrow. So you technically get reimbursed most of the time. but it allows people to roll that cost into the loan and then receive a little bit money, little money after closing too. Yeah. So it's a very, very simple refinance process, especially in this market. If you're, we're in a higher rate environment, I believe that there's going to be a lot of refinance opportunities in the future. So that's going to be very easy to do when you're in a VA loan.
I often get asked if on a VA loan, if they can do a HELOC. Is there any issue with doing a HELOC on a VA loan?
And go back and explain what HELOC is for those
I'm
of
sorry,
us that are not familiar with those terms.
A home line of credit, basically. So if there's
Yeah.
equity in the home, can they pull that out and use it to, say, fix up their home?
As far as I'm concerned, that's not an issue. Now, cash out refinances with VA, especially in Texas, might be a little bit more expensive. I think the funding fee may go up, or there are some increased costs with that. But with a home equity line, I've even seen HE loans, so not home equity line of credit, just home equity loan, which is just a typically fixed 10 to 20 year loan, versus a HELOC is like a credit card on your house with a variable rate. I have not seen that being an issue, no.
Okay. Yeah, I know here in Texas, a lot of the issue with that is a lot of our service members move about every 3 years. And so they're usually either breaking even or not quite breaking even at the 3-year mark on a VA loan because they put nothing down.
Right.
And so there's really no credit on their home for them to take anything out of. So,
and that's a great point, Aaron. That is one of the great benefits of a VA loan is the 0% down, especially if you might be buying your forever home. But we have to, as mortgage and real estate professionals, advise our clients that you're paying more interest because you're taking a higher loan, right? So that's something that has to be weighed as well. If someone is comfortably able to put a down payment on a home, you're going to pay less in interest, and that might be the best route to go. And your payment's going to be lower too. So, yeah.
Well, what tips or tricks would you give specifically veterans when they're shopping for a VA loan? I get this question a lot, and we always encourage them to get the loan first before they go home shopping. And most veterans, of course, like to do it the opposite way. They feel like they're going to be homeless, and no, let's go find the perfect home first, and then let's shop for the loan. And what kind of tips or tricks would you give to a veteran out there who's looking to purchase a home?
Yeah, and I would say this would go for anybody purchasing a home. You need to have a game plan. You need to have a conversation with a loan officer that sets you up. You do a pre-approval application so they have the full picture and give you a variety of options of what you qualify for. Far out from your home purchase, right? And because people, they may need to put down more to qualify. It might be, you might have to buy down the rate to qualify, whatever it may be. And there's a lot of info thrown at them, and being a, typical home buyer that's starting the mortgage process, especially for first-time home buyers, it could be troublesome. I mean, there's just so much information. So I think the best thing to do for anybody going to look at a home or want to purchase a home is talk with your lender, to be referred to a lender, and have a couple conversations with them and set up a game plan with going to purchase. Yeah.
On that note, I get this all the time. I don't want to talk to a lender because I don't want it to affect my credit. And what if we don't find a house in the specified amount of time? And then I say, well, what's the amount of time? And they always look at me with like deer in the headlights, and they have no idea.
Yeah.
But they've heard that there's a specific amount of time and it's going to affect their credit. So there's a lot of people that are leery to go talk to a lender first. Could you just briefly touch on the amount of time that's good for? And do you pull credit right away? Does it depend on the person? Do you pull credit sometimes down the road? First conversation?
Yeah, that's another great question. It does depend on the person. Some people are completely okay with a credit pull right off the bat, and I always advocate for a hard pull because it's just the best way to go. It gives me all the information. There's not going to be any pop-ups in the future. Another way we could do it is a soft pull, and a lot of lenders just automatically start with a soft pull, which is fine. If you are someone that's starting to have that conversation with your lender, I would ask, is it a full soft pull? Is it showing you just one score, or is it showing you all three? For all three bureaus, because the bureaus report at different times. They have different scores, different metrics, right? So soft pull's okay as long as it's a full soft pull, in my opinion. A one score soft pull could have some missing information. But typically a hard pull on credit is going to be good for 120 days. So you have 4 months. I tell people,
I'm sorry, Alex, how much does it really affect your credit to get a hard pull?
Not much. Sometimes it's a couple points, maybe sometimes it's 10 points. I've had people tell me that their scores went down 20, 30 points.
Whoa.
Yeah, which is I've done a mortgage pull on myself. My scores went down maybe 3 to 5 points.
Okay.
But they rebound as well. So that's the number one thing. When people are saying, "Oh, well, I don't want it to hurt my scores." Well, it's required. We want to make sure you're protected because a credit report is giving me necessary information that I need to pre-approve you and make sure that you qualify for the home, right? But if you continue making timely payments, your scores will rebound and go back up. In the mortgage industry, if you wanted to rate shop, if you wanted to get a second opinion on your pre-approval, you have a window, typically 30 days, to have a different lender pull your credit again without it affecting your scores. So you do have some protection there. Yeah.
Okay, so you could lender shop, talk to 2 or 3 people within a 30-day time frame. It's not going to affect your credit that much after the initial.
It won't affect your credit at all. Yeah.
Okay.
So you get the one pull. It's in a mortgage inquiry. If you have you could have a couple different lenders pull your credit after that, and it won't affect your scores for a little bit of time. Yeah.
So a couple things to touch on with that. I would imagine too, it kind of depends on your market. If you're in a really competitive seller's market, then doing that hard pull and getting a full pre-approval rather than a pre-qualification is going to put you in a better position as a buyer. Having said that, so if I'm the listing agent and I've got a home listed for sale and I get 2 similar offers, good offers, and one is an FHA and one's a VA, is there are there any more hoops that a VA buyer is going to have to jump through that would make me think to advise my client, oh no, don't go for the VA loan, go for the FHA loan? I think there's a lot of people out there who think that.
No.
Right?
There's not. There's simply not. And I do hear that a lot when I talk to realtors about, hey, it's FHA offer, or we took the conventional or the FHA. At the end of the day, if there's problems with the home and the appraiser is going to pick up on those problems, it's going to get reported back to the lender, and the lender may want to see some repairs done. Plain and simple. I've seen it on conventional, seen it on FHA. Luckily, I've not seen it on VA. But I actually, at one of our events last night, there was an appraiser there, and I was just kind of talking with her about her process. She wasn't appraising anything, so it wasn't. LOs have to be careful talking to appraisers. But she was there with, she was friends with some on our team, so we were just kind of picking her brain about stuff. She's like, well, when I go in the home, if I see a watermark on the ceiling, and she didn't even mention loan type or anything, I might note in the report to the lender, roof might need an inspection. And the lender's going to read that, and they're going to request an inspection. And regardless of the loan type. So no, I don't think there's extra hoops that have to be jumped through. Pre-approvals over pre-qualifications, it's huge. Pre-qualifications, and typically you see it with the big banks. They might just do a soft pull. They state income. They just send you a letter. Oh yeah, here you go. You're pre-qualified, but nothing's verified. Pre-approvals verify all your information, right? So if you have a FHA pre-approval and a VA pre-approval, conventional pre-approval, everything's verified. I don't think there really should be any problems, when it comes to picking any of them. And for me as a loan officer, I'm always going to connect with the listing agent and say, hey, my buyer who's with this VA loan is, fully verified. So everything should check out and they should be good to go.
Well, what are some common misconceptions that you run into with people wanting to buy a VHA or a VA loan? Is there something that they assume or they don't assume, or what are some misconceptions?
That there's more hoops to jump through.
Yeah, probably.
There might be more problems that pop up for some reason, but no. If there's a problem with the home, then it might pop up.
No, aren't there more lender required repairs on a VA loan? I mean, there's, at least here in Texas, the list is a lot more stringent on what they will allow on the loan for a VA versus any other type.
I mean, typically they're going to want a pest inspection, right? But usually that's included in a normal inspection anyway. So I wouldn't really qualify that as having to jump through more hoops. I had one that we had to replace the roof buyer buying a home. And this was for an FHA loan, and the appraiser noted, hey, the roof seems a little old. They got a roof inspection. Turns out the roof was 25 years old, and that doesn't qualify for really any program, because you don't want to see the roof that old at all. So we had to replace the roof, right? And repairs. I have this conversation a lot, like, hey, is this house going to qualify? It has these types of problems. That is really difficult to tell up front until you actually get an appraiser in there. Some appraisers might not note things that other appraisers do. Unfortunately, it's just not a linear thing. They supposedly should be, but sometimes it can be, some people pick up on things and some people don't with their inspections,
Okay.
Well, I think that's true for any appraiser. I mean, I've in really busy markets, I've had appraisals come in and I looked at the appraisal report and they reported 2 bathrooms when there were 4. So,
right.
Did they even go in the house? They didn't. But so I want to, does the VA loan take any longer for the approval process? Like, how long would you say in the Charlotte market, for example, if we went under contract, how long could you close? Would it take for you to close a VA loan?
Yeah, great question. So with the things that lenders can control, really when it comes to their speed on turnaround times and getting an appraisal in, I mean, it could be 2 weeks. You can have a clear to close ready to go. So it's a very quick process. Now, then you have things that we can't control, which would be title. Some title companies just take longer than others. We know some, I'm sure you've worked with some that take 3 days, some take 2 weeks, so that's something that we can't control that might, push the clear to close back. But typically a VA loan is a simple process. And same for conventional and USDA. USDA is a little bit longer because the government has to underwrite that loan. So, but conventional, FHA, VA, all typically the same turn times, especially in this market right now when it's a lot slower. So appraisers are not completely backed up like in 2021. They're taking a month to do. Right, we can get appraisals back in 7 days flat, easy.
In addition to the loans maybe taking a little bit longer based on who the lender is, are there any other obstacles that a VA loan may run into that they need to be aware of?
No, 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 I don't. I've never had any obstacles with, yeah, any of the VA loans. Oh. And the reason being is because a lot of the stuff has to do with the pre-approval, right? Because us loan officers have a portal with the VA that we can go in and just type in the buyer's information, make sure they qualify easily for a VA loan. Most of the time they do if they're a veteran or a surviving spouse. So that the boxes are checked prior to going under contract on a home. Yeah.
And in what scenarios would somebody not qualify for a VA loan?
Maybe they just joined the military.
Okay.
that might in terms of timing, and qualification wise, maybe like I said, a lot of times right now it's DTI is too high. Just because
DTI is the debt to income?
Debt to income ratio. Yep. So that's your debts weighed against your income. Debt divided by your income on a monthly scale. So that would be your monthly payments reporting on your credit report. We add in the mortgage payment, the assumed mortgage payment that you're going to have into that as well, right? So we're in a higher interest rate environment, which is creating higher mortgage payments for people that are buying homes right now. So we're seeing a lot more denials lately because of debt to income ratio.
And so what is a good debt to income ratio for just a standard loan, and then a good debt to income ratio for the VA loan?
Yeah, so maxed out conventional is 50, and this is total, your back end debt to income ratio, which is your total debts combined. 50 for conventional, 57 for FHA, and then VA is technically does not have a cap. It's determined by underwriting or our underwriting system, which loan officers use with the pre-approval process. So you don't have to, we figure that out during the pre-approval. But like I said, the highest I've seen so far is I think it was 63 or 64%. Some lenders, though, may have their own caps. It's called an overlay. So even though the VA itself may accept it, the lender you're working with may have their own set of guidelines that they follow as well. Yeah.
So if you were going to start a pre-approval process for a VA loan, where would you start?
Talk with your loan officer, give them all the information that they need, typically just a pre-approval application to start so they can calculate your debt to income ratio. They can pull in a credit report with that. Like I said earlier, if you're hesitant about your credit being pulled, you could start with a soft pull. If you're just kind of feeling it out, seeing if you want to purchase a home or not, then a soft pull is definitely a great start, right? Because it's still going to be a great estimate. If you're like, hey, we're making an offer on this home today, I would recommend a hard pull. So.
And you started out by saying, talk to your loan officer. But if we go back one step beyond that, how do you find a good loan officer for a VA loan?
Your realtor. So VA is one of the 4 conforming loans in the U.S. Like I said in the beginning, VA, conventional, USDA, and FHA. And those are the 4 main loans that really any loan officer working at a typical residential mortgage company is going to be doing. And they should be well versed into all 4 of those programs. Now, there are VA specialists out there. There are some companies that specialize specifically on VA. I grew up in the Topsail Beach area, which, if you know anything, in North Carolina, it's right next to Camp Lejeune. It's one of a large military base. So there was a lot of federal credit unions around there that have their specialty VA stuff because they're right next to the base, and there's a lot of veterans and stuff like that. So you could look for a specific mortgage company, but I would say any loan officer should be well versed in that. And if not, I ask, right? Like if you're talking to a loan officer and say, hey, have you closed a VA loan before?
And if I can jump in real quick, one of the reasons I was so excited about having Alex on today is I have worked with him, and he's so great at working with not only the realtors on both sides of the transaction, but also with that client. So if I referred a client to him who I felt like might have some issues with debt to income or needing to improve their credit scores a little bit, I know that he's really knowledgeable and patient and caring enough that he's going to take the time to work with that client. So to help them get to the point where they can qualify to buy a home, maybe not in the next 30, 60 days, but okay, let's get you on the path where you can be in a position to buy a home. So yeah, working with a realtor you trust, they probably know a loan officer who's going to be able to help a client with their particular set of circumstances.
Thank you, Brooke. Yes, and that made me think of when going back to where to start as a buyer to get a VA loan or any loan, and to find a loan officer to create a plan with. Sometimes people, they might not know, they're not ready. They need help with their credit. Their debt to income ratio may be too high. So a loan officer should be able to give them a specific plan to help them get to that point. Like, hey, you don't qualify now, but how can we get you to qualify in the future? And I have access to credit repair teams. Most loan officers at a lot of companies should too as well. So they can refer the client out to a credit repair team to get their scores up, to just put them in a better financial situation in the future.
You mentioned that the interest rates have risen, making it more difficult and more denials for loans. Are there any recent changes to the VA program that would eliminate some of the denials that are coming through?
I have not personally seen any changes recently. The market has seemed to pick up in the last week or so, that there may be some cuts in interest rates in the future, and that we may be towards the end of the hiking cycle with the Fed. That has been hiking. They're the entity that's been hiking interest rates over the last 18 months or so, trying to slow inflation. Now we are finally starting to see inflation really tame, come down. We had a lot of information come out last week about payroll growth, stuff like that, that's showing us slow in the economy. So hopefully we see some real strong declines in interest rates, especially next year, that can help people qualify for homes. Even if you're qualified for a home now, a lot of people are sitting on the sidelines waiting for interest rates to come down because their mortgage payment might just be too high right now at the price range that they want to buy. So hopefully in the future we do see some declines on the rates to help people out.
Aaron, what are you seeing in Texas as far as home prices, and what's the market like where you are?
We're seeing prices definitely leveling out a lot. A lot of the homes that are for sale, the showings have slowed a lot. I mean, very little showings. But that being said, there's still a lot of homes being bought. There's not as many homes going on the market. So right now, more homes are being sold than homes that are actually being listed. And people are still kind of in that mindset of, we should have our house price really, really high, as opposed to what's actually going on in the market. Those people that are putting their homes just below market value are getting multiple offers almost in any price range right now here. We were working on one yesterday, 600K range, multiple offer situation, second day on the market, listed just below market value. Just over market value, they're pretty much stagnant, little to no showings and pretty slow. So.
Yeah, we're seeing similar in the Charlotte area. It's just kind of a gridlock, right? I mean, and the advice is, price it just below market value to try and generate interest. And people, we're just, the inventory levels are still low, and so it's just kind of the perfect storm. So we're ready for that.
I am seeing people a little more flexible on contingency offers, especially if they extend through the holidays. They're a little more lenient right now with, okay, let me stay in my home. We'll do an RFR on the house, and
What is RFR?
I'm sorry, right of first refusal. So we're going to lock up your home, take it off the market, basically contingent upon our home selling, but you can still actually market it and do showings. If you get an offer that's equal or greater, then you would give us a certain amount of time. That's typically a week or so to either come up with funds and go ahead and close on the deal, or it would go to the next person. So we're seeing a lot more of that at the moment, which is phenomenal. And we haven't seen that through the summer months.
So Alex, what would you say, what's the most common loan type you're writing? Is it FHA or conventional or VA? What do you, conventional you're seeing most?
Yep. Definitely conventional. Yes.
Yeah.
Just because denial rates are very high, and that's typically going to rest with FHA borrowers a lot, unfortunately. And conventional buyers typically have a lot stronger profile, higher FICO scores, higher down payment, whatever it may be, and they can afford the monthly payment. I will say, going off of the time listings are staying on the market now, I've talked to several realtors in the last couple of days that are having a lot of trouble with their listings. Their listings are staying on the market a lot longer. And I think buyers need to take advantage of that right now, especially when you can get seller concessions to cover your closing costs. There are programs out there now that can help you with your down payment if you're not going with a VA loan. Even with the VA loan, the 0% down, you have an opportunity to purchase a home with almost nothing out of pocket if you can get a seller concession. So I think this is a very, very valuable time for home buyers that are sitting on the sidelines, first-time home buyers, veterans, to get to the market and explore their options. So especially if we are at the height of the interest rate cycle, or the peak of the interest rate cycle we're currently in, which no one completely knows. But if rates go down next year, you have an opportunity to refinance. So, and
Absolutely.
That being said, I mean, it's going to cause a flood of buyers that are sitting on the sidelines, which people will end up overpaying either way if they wait.
Exactly.
What we saw a year ago, 2 years ago, 50, 100, 150 over asking, waiving appraisals. So yeah, why wait?
And I learned about your options period in Texas.
Yes.
We have a due diligence period in North Carolina. And I know, correct me if I'm wrong, but options period in Texas, you can get that money back up to the option point, correct?
Earnest money, yeah, is fully refundable and walk away with no questions asked.
Due diligence in North Carolina is not. And in 2021, I saw some really high due diligence amounts being put up on properties. I mean, $100,000 high.
Wow.
And it's non-refundable. So,
and tell us, if you will, what the due diligence is. What is that you're talking about? And
Brooke, you might be a little better.
So in North Carolina, you have a due diligence period. So if, Angela, I'm the buyer and I come in and put an offer in on your house, I'm saying, okay, I want to take your house off the market for 30 days. And during that 30 days, I'm going to try and get my loan. I'm going to do home inspections. My attorney's going to do title work, all of those things. And during this 30-day due diligence period, I can back out for any or no reason at all. I do get my due diligence money back, but my earnest money, I don't. If I back out after my due diligence date, then you get to keep your earnest money. So there's two checks that I, as a buyer, would write. One would be a due diligence fee, which is paid to the seller's consideration for taking your home off the market, missing out on any other opportunities to sell to other people, because somebody else could have swooped in and paid cash for it and I have to do all of this. So you get to keep that I'm sorry, I said that wrong. You get to keep that due diligence money. So that's yours. I write it to you, Angela Brown. I don't get that back. But if I back out after that, then I can get my earnest money back. Otherwise, it applies to the purchase of the house. So yeah, Alex, what he said, I mean, there are people writing really big due diligence checks to the seller that they're not going to get back, but the market was just that competitive. So
How long is your due diligence period typically?
it's whatever the buyer and seller agree to, and it depends on the market. So very often, Alex, wouldn't you say it's maybe 2 weeks within a 30-day close?
Yeah,
So maybe
2 to 3 weeks, yeah.
yeah, 2 to 3 weeks for the due diligence, and that was a big risk for buyers too, because like Alex said, you may not be able to get an appraiser out there in that period of time. So you may not be able to get a surveys here in this area. It's our surveyors are really backed up. It's getting better, but so you may not be able to get all of your due diligence done in that period of time. So it was definitely beneficial to the sellers because they're putting that money in their pocket. If me as a buyer, I back out, oh well, I'm out. You get to keep the money and start it all again with somebody else, and
Yeah.
kind of command your price.
Here are option periods, kind of the same as due diligence, but they're about 5 to 7 days typically. So they move pretty fast here.
Could you get your due diligence done in that time?
So it's mostly for inspections.
And
So
you
we
could get them done, or were they just waiving them?
Well, here a year ago, pretty much everybody was waiving everything. But no, the option period here is to make sure if you've got any contractor questions, inspections that need to be done, you get that done in the shortest amount of time possible. Typically 5 to 7 days is typical. Sometimes they'll push for 10, but it's rare. But on that note, we do have a question that comes up a lot, Alex, and this is for you. As far as buy downs go, I know there's a lot of talk about that right now with sellers in terms of how can we incentivize our property to get it to sell? What can we do working with a lender? What other incentives can we give to get a buyer in the house? Could you talk to us about buy downs for just a minute, how those work, and how that would be beneficial to a seller and a buyer?
Absolutely, yeah. So buy downs essentially is money funded in an escrow or sits in an escrow account, and it pays the difference between your note rate on your mortgage and the buy down rate. And really, the buy down rate is just that difference between the two payments that's getting paid by this escrow account. So you can have multiple different types of buy downs. You have a 1-0, 2-1-0, 3-1-0, and those are your years that your interest rate is the period that your interest rate is lower than the note rate. And just think of the note rate like the starting rate, like your normal interest rate. Like in this market, we'll just call it 7.5. That's your note rate. If I have a buy down that is 1-0, your interest rate is 1% lower for a year. So then if it's 7.5 or 7.5, you drop to 6.5 for 1 year, right? And whatever the difference of those two payments were between 7.5 and 6.5, this separate escrow account is going to pay that for the buyer for that first year, and so on and so forth. How that account is funded is where sellers can maybe grab some attention to their listing. They can offer to give the buyer some money towards the buy down to fund their account. Buyers might even just want to do it themselves. I've seen lenders do lender paid buy downs now because originally when it came out a year ago or so, only the seller or the realtor could fund it unless the buyer wanted to do it themselves. So now we're seeing lenders pay for it as well to be competitive, or partner with listing agents and put it, say, hey, we'll fund a buy down for your seller, if we're able to work with the buyer. So personally, it's a set amount of money, right? And you can use that money for other things. So you could use it for the buy down, and it's set in this escrow account, or you could use it to pay your closing costs, and then you don't have to come up with a lump sum of money at closing. So personally, I would use the money to pay my closing costs instead of it just sitting in an account, because I could theoretically just do the buy down on my own, right? If the buy down was $55,000 to do, I could just set that in my own bank account and just pay the difference a month on whatever the payments would be, right? I'd much rather.
How does the seller figure out what the buy down amount is? Say they wanted to buy down a point or a half a point.
Right. So the buy down, well, okay. Now I think I see your question. Were you talking about a temporary buy down or the buying down of interest rate?
So we have here in our market, sellers, to incentivize their properties, typically say, hey, we'll give X amount in a bonus to realtors. And right now the realtors are saying, instead of giving us a bonus, buy down the points.
Gotcha.
Buy down the point for the buyers. And so take that money and basically give it to the buyer instead of to us. That would be more incentive to get your house moved.
Yes. Okay. What I was explaining was a temporary buy down, which is a loan product that most lenders are offering right now, which can be used to, can be advertised on a listing. Buying down points in general, points on interest rate, that's the cost for an interest rate. It's the initial investment that a buyer uses to get a lower interest rate. So if you wanted to advertise seller concessions on a listing you may have, that's going to attract some buyers, and those buyers can use that money to buy down points if they'd like to, but they don't necessarily have to, because at the end of the day, it's all a bottom line figure. You have your down payment and you have your closing costs. Your closing costs can vary depending on if you want to buy down the interest rate or not. So let's say you have a listing and your seller agrees to give the buyer $5,000 towards their closing costs. That buyer can either cover their closing costs up front, have like a zero closing cost transaction, or they can choose to buy down the interest rate a little bit too.
Okay.
Yeah.
So they could use that money however they wanted. It would just be money set aside into escrow, and however the buyer wants to use it. Lender's okay with that.
So just a typical seller concession is going to be used at closing. It has to. All the seller concession must be used in some way. A buyer cannot receive a check from the seller with leftover money. The temporary buy down, which is used to bring down your interest rate for a year or so, that's going to be set in an escrow account. That money will be set in an escrow account.
This has been such great information, not only about just the veterans products, but all loan products as well. And I think it's so important to know that if you are thinking of buying a home or refinancing a home, really you need to find somebody who's very knowledgeable and who's going to take the time to explain all of this, because there's so many moving parts to a mortgage, but super timely as we're going into the Veterans Day weekend. I really appreciate you, Alex, sharing this, and hope that all of those veterans out there know how much we appreciate the sacrifices that they have made for us going into this weekend. So, all that being said, I want to thank everybody for coming today. Alex, can you tell our audience where they can find you?
Yes, you can look up my name, Alex Mignone. My website with American Pacific Mortgage should pop right up, or my Google page as well. I'm located in Charlotte, North Carolina, so you should be able to easily find me on Google to get to my page. And my name and number is on there as well, and my email. You can contact me, call, text, or email if you have any questions.
Great, and we'll have all of your information in the comments too, and the information below too. And Aaron, can you tell everybody where they can find you if they're looking to do some real estate business in Texas?
Absolutely. At Ask Aaron Brown. You can find me pretty much on any social media. So. And Alex, thank you so much for being here today. That was so insightful, such a fun conversation, and you have such a depth of knowledge when it comes to loans. Thank you.
Absolutely. And Angela, where can our audience find you to get their house clean and ready to put on the market?
Yay, clean houses. I'm Ask Angela Brown on all of the social medias. And thank you so much for having me here today. I just really enjoyed being a fly on the wall and watching all this happen and answering all my questions. Thank you, Alex. Thank you, Brooke. Thank you, Aaron.
And I am Brooke Bryant. I'm in the Charlotte, North Carolina area. And if you have any real estate needs, I'm so happy to help you. And again, I want to thank everybody who chimed in today. Alex, thank you so much for that great information. Thank you for working with our veterans. And thank you, veterans, for all that you've sacrificed for our country. And we'll see everybody next time on